Assalamualaikum warahmatullahi wabarakatuh and good morning. In this last video, we will be talking about the periodic inventory system. Things might be slightly different in periodic inventory system. In terms of recording, it will be quite significant different. Okay, because under the periodic inventory system, there is no running account on changes inventory. The inventory account will not be updated or every time there's a transaction in sales or purchase transaction. Whereas in the perpetual inventory system, whenever there's a sale or purchase, the inventory account will be updated. Okay, but here the inventory account is not updated. It is updated only at the end of the accounting period. Okay, and it is updated at the end of the accounting period based on the physical count being done on the inventory at the warehouse. Okay, cost of goods sold is also not determined until the end of the period. Only at the end of the period do we calculate the cost of goods sold, and the cost of goods sold will be calculated inside the income statement. Whereas in the perpetual system, the cost of goods sold is a running account. The amount is also always updated due to sales, and therefore at the end of the period we just take the ending balance, the adjusted ending balance if needed. We put it inside the income statement. But here in perpetual periodic system, the cost of goods sold is shown as a calculation in the income statement. Okay, we will show the difference here. Okay, so this is the calculation of cost of goods sold. Okay, so cost of goods sold is a calculation. So it comes from a beginning inventory. Okay, beginning inventory. It adds with the purchases. Okay, the beginning inventory add purchases, where it adds the net purchases, but then net purchases comes from the purchase itself, but less the purchase returns and purchase discount. Okay, and then we add the freight in. That will become the cost of goods purchased, the cost of all the goods that have been purchased. Okay, and so 320,000 comes from the purchase until the net purchase. Okay, and the freight in, and then we add that to the opening inventory. Okay, when we add opening inventory, it will become the cost of goods available for sale, which is 356,000, and then from there we minus the ending inventory and we come to the cost of goods sold. Remember our diagram in the first video of this series of lecture. Okay, this is the diagram that we saw much earlier in our first video. Okay, we have a beginning inventory. We add that to the cost of goods purchased, which include the purchase amount, and then minus the purchase discount and purchase allowance. So we add the beginning inventory with purchase, we will get the cost of goods available for sale, because we have a beginning inventory. We have a beginning inventory, we add that with the with things that we have recently bought, and that will become the cost of goods available for sale. Those items that are available for sale, and we look at the cost. And from those goods available for sale, some of them are sold, but some are not sold. So, but we are interested in the cost of goods that have been sold, because we want to match those costs of items being sold with those items that have been sold. Okay, the selling amount. Okay, so we need to take away from cost of goods available for sale. We need to take away the ending inventory from that one. The balance is the cost of goods sold. That is why we need to do these the calculation that we have shown in the other slide. Right. Like we've seen in the diagram, that's how we come up with these calculations. Okay, from the diagram, we've seen that first we have an inventory, a beginning inventory. We add the cost of goods purchased with the inventory, and we come up with the cost of goods available for sale, and from there we deduct the ending inventory in order for us to obtain the cost of goods sold, which we will match with our revenue account, our sales revenue account. Okay, so how do we record merchandising transactions under the periodic inventory system? Okay, so we record revenues when sales are made. This is similar, but we do not record the cost of merchandise sold on the date of sale. Okay, we do not record the cost of goods sold. Like I said, we calculate the cost of goods sold in the income statement. Physical inventory count determines cost of merchandise on hand and cost of merchandise sold during the period. Therefore, physical inventory count is important. It is definitely important for the periodic inventory system, because it will be used to know the inventory level, as well as to calculate the cost of goods sold at the end of the period. And when we do purchases under the periodic inventory system, we use the purchase account. Remember, in the periodic system, there's no purchases account used. When we purchase an item, when we purchase inventory, we will debit inventory and we will credit either cash or we will credit accounts payable. But under merchandise and the periodic inventory system, we use the purchases account instead, and we do not touch our inventory account until the very end of the accounting period. Okay. Purchase returns and allowance, purchase discount, and freight costs are all used using separate accounts. Whereas usually when there's a purchase return or purchase discount and freight costs, we will update our inventory account. That is done under the periodic system. But under the under the perpetual system, under the periodic system, we use all these accounts. Okay. So let us look at some example on the basis of sales invoice again and receipt of the merchandise ordered from PW order supply. Soup Stereo records 3,800 purchase as follows. This is how they Soup Stereo would record a purchase. They would debit purchases 3,800 and they will credit accounts payable by 3,800. Okay, when there's freight cost should be borne by the purchaser, the buyer, then the buyer should record it as a debit in freight in 150 and credit cash 150. Previously in the periodic perpetual inventory system, it will be a debit to inventory because we want to update the inventory cost, and of course credit cash. But here we debit our freight in account instead. If there's a purchase return and allowance, previously we would update our inventory account again. We will debit, we will credit our inventory account because our inventory cost is reduced due to the purchase return and allowance. But here we will credit our purchase returns and allowance account. Okay, we will credit a separate account for this. Of course, we will debit our accounts payable because we are reducing our owing to our supplier. When there's a purchase discount, on May 14, Soup Stereo pays the balance due on account. Okay, we pay the balance account, but we receive a discount. Okay, 2% cash discount. So how should we record this? We will record it as accounts payable 3,500 because we are satisfying the net balance of our owing, which is 3,500. But then we are not paying the cash, the total cash of 3,500. The cash we pay is only 3,430. We have illustrated the calculation for this. But $70 is due to the discount, and we credit the purchase discount account. This is some sort of a revenue account, but Actually is a contra account to purchase. Okay, is a contra account to purchase, but its nature is like a revenue account. Okay, but it's actually a contra account to the purchase account. And so we create a separate account called purchase discount to put our discount amount. Whereas in the perpetual system, here we will put inventory account. Okay, we will summarize the difference between these two inventory systems. Okay, when we do a sale, okay, when audio supplier makes the sale, of course there's a recording for the sale, accounts receivable of 3,800 and a credit of sales revenue for 3,800. But there's no record for the cost of goods sold, and there's no record for the inventory, because the periodic system, in the periodic system, we do not update our cost of goods sold and inventory during the transactions, but we only update those accounts at the end of the period. Okay, so it is simpler in this sense. Okay, the periodic system is simpler for sales transaction because we only do one set of transaction, whereas in the perpetual system we need to do two sets of recording. Okay. For sales return and allowance, also it's much also simpler. There's only one set of transaction. Okay, when we do sales returns, when the customer returns product to us, then we debit our sales return and allowances, and we credit our accounts receivable. We do not need to do a second set of transaction or recording to update our cost of goods sold and our inventory accounts. We do not need to do that in the periodic system. Sales discount, so it's similar. When we make discounts to our customers, then of course we will receive cash, but the net cash, we should receive 3,500, but because of the discount we receive only 3,430. So $70 we will debit our sales discount account, and then we will credit our accounts receivable account, and that's it. We do not need to do any adjustment on cost of goods sold and inventory account. Okay. So now we see a summary of the differences between the perpetual inventory system and the periodic inventory system. Okay, so on 4th May, this is in the books of Sook Stereo. Okay, so on 4th of May, Sook Stereo purchased merchandise on credit. In the perpetual inventory system, they would debit inventory by 3,800 and credit accounts payable by 3,800. But in the periodic inventory system, instead of debiting inventory, they would debit purchase account. Okay. On 6th of May, Sook is paying for the freight cost. So to pay for freight cost, they would debit inventory by 350 because they want to update the cost of inventory due to the freight. But under the periodic system, they would charge it to a different account, which is called freight in account, which is an expense account. Okay, they will put it in under expense account. On 8th of May, they made return. Okay, so Stereo made a return. So to make a return, of course, they would debit accounts payable by 300. It's the same on both ways, but they will update the inventory accounts by 300 because they have returned some of the inventory back to the seller, their inventory level has reduced. Therefore, we need to credit inventory. But in the periodic inventory system, we do not update our inventory account. Instead, we create another account called purchase returns and allowance, and we credit that account by $300, which is this purchase returns and allowance is similar in behavior to a revenue account, but it's actually a contra account to a purchase account. On 14th of May, Sook Stereo will pay the amount of owing, but there's some discount. Therefore, they would debit accounts payable 3,500. They will credit cash by 3,430. But the remainder, the $70 discount, will be credited to an inventory account because it actually reduces the the cost inventory. A discount will reduce the cost of inventory. Therefore, they will credit inventory account. But in this in the periodic inventory system, they would credit purchase discount, which is some sort of a revenue account, but a contra to purchase account. Okay, so this is summarizes the sum of the transactions. And then in terms of the sale, this is even more different here, more differences here. Okay, this is from Audio Supplies books, how they record the sales transaction. When they on 4th of May, they sold the item to Suk, to the buyer. When they sell under the perpetual inventory system, they will record it as two set of recording. One is the sale, which is they would debit accounts receivable and credit sales revenue to record the sale, but they will also do the recording for matching of expense. So the expense that they need to update is the cost of goods sold, 2,400, and inventory of 2,400, because now when they have sold the inventory is no longer there, so they need to reduce inventory by 2,400. Under the periodic system, there's no need to do these set of transaction. Okay, no entry for cost of goods sold. When there's a return of merchandise sold, again, when there's a return of merchandise sold, under perpetual inventory system, PW Audio needed to do two sets of recording. One for the sales return and the other for updating inventory and cost of goods sold. We have done this before. But periodic inventory system, there's no need to do the second set. To update inventory and cost of goods sold is not needed. Okay, inventory and cost of goods sold is only arrived at the end of the period. Okay, so there's no entry here. When cash is received, it will be the same. Okay, so these two slides are very important because they summarize summarize the differences between perpetual and the periodic inventory system. So you need to understand this very clearly, and you need to understand how the organization runs their business, which inventory system that they will be using. Okay, and this will be the worksheet used for companies that use the periodic inventory system. So the periodic inventory system, firstly will be the inventory account. So inventory account, the trial balance here, this trial balance will actually be the beginning balance of inventory. It's the same. Okay, trial balance here will be the beginning balance of the inventory, because there's no movement in inventory account under periodic system. Okay, but under the income statement, there will be two on both sides, debit side and credit side. Why? Because there are two types of inventory there. The beginning inventory, in order for us to come up with the net income, we need to find out the gross profit, and to come up with the gross profit, we need to find out what is the net purchase. We need to find out what's the cost of goods sold, and in order to come up with the cost of goods sold, we need to have the beginning inventory and the ending inventory. So here, under income statement, on the debit side, we put the beginning inventory, and on the credit side, we put the ending inventory. Okay, so this is the major difference for inventory in the worksheet. Okay, we put the credit balance, the ending balance of inventory under the credit side of the income statement, and we also put the ending inventory to the debit side of the balance sheet. So our balance sheet should show the ending inventory. But the original trial balance will have a beginning inventory, or in the income statement we'll have both the beginning and the ending to calculate, because they both of these are used to calculate the cost of goods sold. Okay, there's no account of cost of goods sold account with periodic system in the worksheet. There's no cost of goods sold here, but cost of goods sold is derived from the beginning and ending inventory, and also the purchase amounts. Okay, so if you see purchase amounts here, okay, so you see purchases account will go into the trial balance, will go into the adjusted trial balance, will go into the income statement. Under the what do you call it? Under the the perpetual system, you will not have purchase returns and allowance and purchase discounts in the worksheet, because these accounts are not used in perpetual system, whereas perpetual system use or update the inventory using the inventory account and cost of goods sold. Okay, they do not use purchases accounts. Okay, but under the periodic inventory system, because these accounts are used, therefore they must be inserted into the worksheet to go under the trial balance, the adjusted trial balance, as well as the income statement. Okay, and there's no cost of goods sold under income statement for periodic inventory system, but the other items will be the same.